So in this question, on January 1st, year 3, Stony Corp purchased all of Brook Corp's common stock. Now, on the date of the acquisition, right, for Brook, they would have to assess what is the fair value of all of the assets and liabilities. Because typically what happens is that Stony would just upload Brook's trial balance, which is all at the cost base or historical book values that Brook has, right? But we need to value all those assets and liabilities to assess, is there a difference between the book value and fair value, right? That is one of the steps in the acquisition method, and we can see in our visual, right, that is step number 4. So basically, Stony would pay some sort of accounting firm to do this assessment of fair value, and they came back and basically said everything is the same except for inventory, right? And inventory had a market value that is $50,000 greater than its carrying value. So fast forward to the end of the year, it's now December 31, year 3, and we need to prepare the consolidated balance sheet, right? And it says there's no change to the fair value of the assets or liabilities from the acquisition date to this year-end balance sheet date. Now we're given some current asset information for both Stony and Brook as of December 31, year 3. Ultimately, the question is asking us on the consolidated balance sheet for December 31, year 3, what would be reported as total current assets? And it's not really that difficult. All we need to do is take Stony's current assets of $185,000 plus Brook's current assets of $95,000. But there's one little thing we can't forget, and that's that the inventory for Brook is at the historical book value and not the fair value. Remember, the fair value was $50,000 higher. So what we need to do is actually increase the inventory for Brook by $50,000. And when we do that, well, we get all the way up to total current assets in the consolidated balance sheet of $330,000, right? So that's going to be the correct answer. So when you see questions like this that talk about an acquisition during the year and then you need to prepare the consolidated balance sheet for the end of that year, this is something that we cannot forget, right? We must always factor in any step up in fair value for assets and liabilities, right? This is a tricky one that they always love to incorporate for this type of question. So keep it in mind. You'll see it again in a simulation in this platform, right? I promise you that.